Good afternoon, everyone. Good afternoon. Good afternoon. So I'm going to start today with a few books that I want to put out there for you guys. Good afternoon, everyone. I'm going to put a couple of books out here for you guys before we get started. So that's one. That's one. Let me pin that one. And then two. And I can't remember the author of that one. So, okay, starting out today, I can only pin one at a time. Okay, so good afternoon, good afternoon. This is another hashtag Get Real Woke, hashtag Make It Make Sense, hashtag, as always, for the free. So today we are going to talk about understanding the fractionalized reserve banking system. And this is going to be very important because, we talked about current accounts and timed accounts last week. And so now when I give you a little bit of how fractionalized reserve banking works, I think a lot of y'all are going to get mad because you probably don't know this. But, I think it's going to be helpful for you to understand why it is that not only banks, but Wall Street in general kind of tends to work this way, from IRAs to Roth IRAs to 401ks to different types of exotic investments like hedge funds, private equity funds, etc., etc. They all kind of tend to follow this model, and there's a reason. So let's break down. Happy Sunday, Anna. How are you? So let's get started, right? Okay. So before I get into fractionalized reserve banking, I want to give you a little bit of a history of where this comes from, right? And so I put a book out there. Unfortunately, I can only pin one book at a time, or pin one thing at a time. So I'll just give you the name of this book. It's called The Ascent of Money by Niall Ferguson. It's called The Ascent of Money by Niall Ferguson. Right? He wrote a really, really good book on the history of kind of how banking and finance kind of got started, right? So I'll give you a little bit of that history. I'm going to give you a bit of an overview of how we got where we are today. Okay, so before there were banks, before there was currency, before there was anything like that, there was what was called the barter system, right? And so what would happen is, one person would trade with another person, or one person would use goods from one thing to get goods for another thing, right? And this was known as the barter system. And so what happened is, as economies began to grow, as merchants began to grow, as population began to grow, people needed more and more and more things. And back in those days, they didn't have cars like we have, so they would have their little horse-drawn buggies and the little carts, and they would have to go long distances to be able to transact business at the market or transact business with someone else that they needed something from. So they would bring large hay, things like that, etc., etc. Well, along this long journey, what would happen is there were these things called these people, really, they weren't things, they were people, and they were called highway robbers. And the highway robbers would hide in the woods, and they would wait for the carts to pass, and then they would attempt to rob the carts. And oftentimes they were successful. And so people were losing a lot of their tangible goods on the way to the market or on the way to transact business with someone else. And so, this was a huge hit to the economic growth of economies. Now, so beyond that, what became a kind of a staple of currency after there was like wheat and grain and barley, it became precious metals. So precious metals became a big currency during this time, right? And so where, as opposed to people moving around with grain and barley and cows, what they were doing was moving around with gold and silver. And because gold and silver became the standard go-to currency for transacting or trading or doing any type of merchant type business, right? What ended up happening is the value of that gold and that silver began to go up. And because of that, the highway robbers, of course, if you need to buy a lot of stuff, you got to carry a lot of gold. And so the highway robbers knew there would be a lot of gold and or silver on these carts that were going these long ways. And so, of course, like they were robbing the grain and barley and things like that, they started robbing the gold and silver. And this was a big problem for a long period of time in history. So finally what happened is a couple of smart guys got together and they decided that they would start vaults. And what these vaults did, they were large storehouses, and they had locks and security and all of that great stuff, people that would watch it and things like that. And they would allow you to store your gold and or your silver in these large storehouses. And what they would do is calculate the value of your gold, and then they would issue you a piece of paper, which was the value of that gold. This is where the first note comes from. This is the note history here. This is where the first note, the first paper currency began to have life. And so now, instead of course, having all of this gold that you had to travel long distances of long spaces and reaches of time with, right? Now you had a piece of paper. And this piece of paper was the value of your gold written out and signed by one of these vaults. And it was a lot easier to conceal, a lot easier to carry, and of course you didn't have to worry so much about getting robbed about it, right? So because, you never knew if somebody had a note or they didn't. So the odds of getting robbed was a lot less. Now, so what happens is, along the way, people are exchanging notes now. Now, note exchange becomes a big part of currency, and these notes become the foundation of economic growth. So what happens? So these guys that have these vaults, that have all this gold and silver in it, they realize something. So before I get into that, so first and foremost, when you gave a note to someone else, right, that person could then go to that vault and withdraw the amount of gold that you wrote them a note for, because the note you gave them said that you had X amount of gold in the vault. And so if they wanted to redeem their note for the actual physical gold, they could go to the vault and they could get the gold, right? Now, what happened, right? Let's talk about what happened. It's interesting. So, of course, these people with these gold and silver vaults begin to realize a thing. They realize that not everyone comes to get their gold at one time. So they realized that what they could do then is they could estimate the amount of people that would come get gold at any one period of time, and they could track that over a period of time to see what the average was. And once they figured out the average amount of people that would come get gold at any one time, what they realized they could do is they could then loan out notes. They could give you a note, right, that's backed by gold in the vault that's someone else's. Because the fact of the matter is, you're not going to come get it all anyway, so I'll loan your gold to someone else and I'll charge them an interest rate. Right? So this is the basis of banking, right? You got to kind of understand how this works, because it works the same way today, but we're going to get into that, right? So check this out, right? So now they're issuing all these notes on this gold. It's the same gold, but they're issuing several different people loans against the same gold. What do you think happens? Eventually, the people that are getting these notes decide they want to come and go get the gold. So you have more people wanting to take out gold than there's gold in the vault. And so the gold vaults fold because they don't have enough. And this interesting metamorphosis, it progresses into what became known as banks in the United States. It started in Europe, Africa, Asia. It eventually made it to the United States. So now, let's fast forward. Now we have banks. And these banks did the same thing. What they would do is they would project the amount of people. So you come in, you make a deposit into the bank. And the bank would then project the amount of people that would come get money out of the bank at any one time. And they figured out an average. And so what they would do then is loan your money to other people. Eventually, though, what ends up happening here is through things like the savings and loan crisis of the 1980s, the panic of 1907, etc., etc., there are different points in history where something would happen in the stock market, something would happen in the overall economy, and more people would want their money than the banks had projected the average is. The banks wouldn't have the money, and the banks would fail. So what happens here is, of course, if you can't instill confidence and trust in the banking system, you can't grow and scale an economy. You can't become a global economic force. You can't do business with other countries because you don't have a backstop or a lump sum of currency to do business with. Enters the Federal Reserve Act in the United States. And you'll see that I pinned a book there for you guys to read. It's called The Creature from Jekyll Island, right? It's a great book. If you really want to understand the nuances of how the Federal Reserve Act came into being, you need to read that book. Now, so here's what happens. A group of bankers and a couple senators get together. J.P. Morgan was one of these bankers. Paul Wahlberg, the Rothschilds, one of the Rothschild members, one of the Rockefeller members. They all got together on an island called Jekyll Island, which is down in Georgia. And they crafted a piece of legislation called the Federal Reserve Act. Yes, so the Rothschilds are Jews, the Rockefellers are American, but I think they have some Jewish history as well. The Wahlbergs are Jews. Yes. So banking, lending, and that thing, right? So that is primarily a Jewish machination. And the reason why that is, just to go back into the history a little bit and give you an explanation from that, because that was a great question, Anna. So I'm going to give you an answer for that. So back before the Federal Reserve Act and banks and all of that, so lending was considered, and still is in Islam, haram. You couldn't charge interest for your money. But the Catholic Church had the same belief that good Catholic people should not be charging interest on the money that they give someone else, right? So this was considered a sin. This was considered bad. And so the two largest religious demographics in the world had barred the ability of their people to lend money amongst themselves and to other people to charge interest, right? So this is where the Jews come into play. The Jews never had these rules, right? The Jews were okay lending to everyone. So what was happening is the Jewish community was lending money to the Christians, right? To the Catholics, right? And they were making interest. Well, eventually the Pope saw how much money the Jewish community was making in interest and decided that he would make it legal for Christians to engage in interest-based lending as well. But by that point in time, the Jews, because they were always into gold and silver anyway, that was always a primary business of theirs, they had already had a foothold on the lending. And so that's why you see primarily that throughout history, the Jews have always kind of led the way with this because they kind of got into it first, right? Because of the way, religious regulation was set up at those times. So now, let's get back to this Federal Reserve Act. So, what happens here is, now the Federal Reserve Act is instituted by these bankers and these couple senators, right? So they get it through, they draft it up, they craft it up on Jekyll Island in Georgia, they bring it back, they bring it to Congress, and they're able to get it passed. The Federal Reserve Act establishes what's called the Federal Reserve Bank, which we still use today. Now be clear, The Federal Reserve Bank is not a government entity. It is not owned by the government. A lot of people don't know that, but the Federal Reserve Bank is actually not owned by the government. It is a quasi-government entity. So this is what happens, right? Every federally chartered bank that has a license from the Federal Reserve Bank to operate as a federally chartered bank in the United States also owns shares in the Federal Reserve Bank. So it's the bankers owning the bank in the United States, the central bank in the United States that sets monetary policy for everyone else, right? And we're gonna get all the way into this. It gets real deep, right? So it's really interesting when you look at how this is set up. Now, so under the Federal Reserve Act, they institute a thing called FDIC insurance. They basically put insurance in place so that way, if too many people come to the bank asking for their money and the banks don't have it, then the Federal Deposit Insurance Company would come in and cover this to a certain dollar amount. Now, here's the interesting thing. The Federal Deposit Insurance Company is a government entity. So what you realize is that it's tax money from the citizens that fund the Federal Deposit Insurance Company. Or corporation. So in the event, right, that a bank fails, it's tax money that's going to come in and cover those deposits, right? So you have a central bank that dictates monetary policy for the banks, right? And if everything goes left, well, the taxpayers will come in and pay anyway up to a certain dollar amount on deposits. Isn't it interesting how this works out? Welcome to the Federal Reserve Act. Now, it gets even better. So under the Federal Reserve Act, there was a piece of that act that set what's called a Federal Reserve requirement. A reserve requirement. All banks have to have a reserve requirement, right? And it's the same. It's 10%. The reserve requirement at every bank is 10%. What does that mean? That means for every dollar that you deposit in the bank only has to hold 10 cents of it. They can lend out the rest legally. So they only have to maintain 10% of your money in the bank at any time. That is the rule. That is how it works. So when you go in to get a loan for a house or a car from the bank, the bank is essentially loaning you money from their deposits. It's not their money. It's their deposit base's money, right? And you pay an interest to the bank. And this is why when you have checking accounts, you get such a paltry interest rate. Because most of that interest goes into the bank. It's their profit. So they lend out your money and they get most of the interest from your money that they're lending out to someone else that's yours. Now, gets even more interesting, right? So not only does the Federal Reserve Bank set monetary policy in the United States, but everybody in the United States, up to and including the government, borrows money from the Federal Reserve Bank. See, we're a debt-driven economy, and most people don't know that. But the government, when they issue bonds, like when the government issues like a 10-year treasury or a 5-year treasury, they might issue $1 billion of treasuries, right? And so they'll sell them overseas. Now, let's say they issue $1 billion in treasuries, and they're only able to sell $500 million of those. Well, where does the other $500 million go? It goes to the Federal Reserve Bank. And the Federal Reserve Bank then lends money to the government and charges the government an interest rate. That's how it works. A lot of stuff you guys don't know, right? So check this out, right? So now, so the interesting and exciting thing about this, right, is now you kind of understand when I was talking about time deposits, why banks want you to have CDs, right? Why banks want you to do 401k and IRAs and all of these great, wonderful things, because they can hold your money for a long period of time. And by being able to hold your money for a long period of time, they can count that money. They know it's going to be there, so it's easy to lend out for an interest rate. That's how it works. The core of banking is deposit taking and lending and securitization. That's it. That's the whole game. So really, if you really look at it, right, it's kind of quasi, when you really look at it, banking is kind of quasi a Ponzi scheme almost, right? It just has legal legislation to make it okay to do it. But I guarantee you, if you tried to do this exact same thing by yourself, you're going to jail for wire fraud. That's how this works. And see, you have to understand that the government and the Federal Reserve Bank are linked together, right? They're tied together. They're tied to the same horse. They can't allow the Federal Reserve Bank to fail. Where are they going to get their money from when they need to borrow money, right? So got to think about that now, right? So what happens when these federally chartered banks, these state chartered banks, what happens when they get in trouble? What happens if they do crazy lending like they did in 2008? Well, the government will pass legislation to bail them out. They got to save them. They have to maintain the confidence in banking, because if the community, if the constituents, if the citizens of a country lose confidence in the banking system, then the whole house of cards falls down. Then you can no longer operate the economy in a debt-driven way. Now, here's the interesting thing. When the Federal Reserve Act was first passed, the dollar was backed by gold. So the dollar was tied to what is called the gold standard. There used to be a point in time in this country, up until Richard Nixon, and we'll get there. There used to be a point in time in this country where you could actually take $1 of your money and actually exchange it for real gold. There used to be a time that was possible. But if the currency is tied to an underlying instrument like gold, or an underlying commodity like gold, right? Well, it's really difficult to print more than you actually have, because at any time it's backed by gold. So you can only print what you have the amount of gold for, right? In theory. So what other countries began to notice, and this was during the Vietnam War, was that the United States government was printing an awful lot of money and funding their war to an extensive amount, and people weren't so sure that the United States government had enough gold to back all this money they were printing. So what did they do? Congress got together again, and Richard Nixon signed it, and they closed the gold standard. So they disconnected gold from the dollar. And ever since that time, the dollar has been what you call a fiat currency. It is only backed by the good faith and credibility of the United States government. That's it. There's nothing else that backs that. So, granted, yes, you could say from an economic policy standpoint, you could say that it's backed by gross domestic product, but technically that's not the case. It's technically not the case, because we print more currency than we have gross domestic product to support. So you can't technically say that it's backed by gross domestic product, because it's not intrinsically tied to gross domestic product. It's just not, right? So what closing the gold standard did, it allowed an elasticity in the currency, right? So they could print it or retract it as they saw fit. And that has a lot of uses, right? So from quantitative easing to, being able to stabilize an economy, there is, so there's always a way. So Anna asked a good question here. It says, so how will it fail the U.S. eventually? Well, interestingly enough, the United States isn't the only one doing this. It's done globally now. Everybody operates in a fiat currency and prints more currency than they have gross domestic product to support. So that's just it. We're a debt-driven economy. We're a globally driven, debt-driven economy. That's how it works. It's always worked this way. And so I kind of want you to understand this, because it becomes very important when we start talking about lending, right? And how lending works, right? Because you have to understand how the Federal Reserve System works and how fractionalized reserve banking works to be able to understand how lending really works, and to be able to understand why it is that when you get into certain investments, they want you to lock up your money for 12 months or 24 months or a year. Because, see, this has expanded beyond banking now. So hedge funds, private equity firms, 401k sponsors, IRA sponsors, ETFs, everybody does the same thing now. So if they know if they have your money locked up for a period of time, they're able to put that money in safe securities and borrow against that money at a very low interest rate and leverage that money, right? So, they're borrowing 2-3 times what they have in cash against the cash, putting the cash in safe securities to offset some of the interest, and then, investing that lended money into tangible or intangible investments to try to make money for themselves and make money for their investor base, right? So that's kind of how it works. Now, here's the interesting thing, and you gotta kind of understand accounting a little bit to see how this works. When you deposit money into a bank, it's an asset, right? It's an asset for the bank. It's a depository asset. So they get to count it as an asset on the balance sheet. Now wait, it gets better. When they loan your money out, right? So when they loan your money out, it too is called an asset because someone owes them money. So they get to book that as an asset as well. So it's very interesting that you can take $1 in banking. If you deposit $1, it counts as a deposit, and once they lend it out, it still counts as a deposit. It still counts as an asset, so they get a 2-to-1 on dollars. So when you see a bank that's like $1 trillion in assets under management, well, there's some interesting accounting that works for banks that doesn't work for everyone else, right? And so you kind of got to understand that they're getting a 2-to-1 on the dollar on the deposit base once they turn and lend it, right? So, well, you could say $1 trillion in assets. Yeah, it's not exactly $1 trillion, legitimately. Like, well, I can't say legitimately because these are legal accounting practices. So it's legitimately $1 trillion. But I mean, when you really look through how the accounting works from a banking standpoint, so, it's not the same. So an asset is, Anna asked, what is an asset? And we'll get into this when we talk about lending and corporations and stuff like this. We're going to start corporations next week, but different business structures. But when you talk about an asset, you have two sides of a balance sheet. You have assets and you have liabilities, right? So any expense I have, any fixed expenses that I have, any payroll that I have, anything like that is an expense. If I buy a piece of real estate, it's an asset. If I buy a stock, it's also an asset, right? So anything that I buy that can generate money for me or appreciate in value is an asset. Anything that I buy that depreciates in value or has a fixed expense to it or a fixed cost to it is a liability. So for example, if I buy a TV and I finance that TV is a liability to me. I owe money on that TV. I borrowed money on that TV. It's a liability, right? Now, if I buy that TV outright, then it becomes a depreciable asset, right? So there's, you got to understand where it fits in the asset or liabilities column. But that's, in a nutshell, what assets and liabilities are. And I'm going to go into that very deeply when we talk about corporate structure, because understanding assets and liabilities is very important when you're dealing with corporate structures. So a deposit, for a bank standpoint, when you deposit money in the bank, it's counted as an asset. When they turn and lend that money, it's also counted as an asset again. So they're getting a 2-to-1 on the asset column. You see how that works. So that's a very interesting set of circumstances. And that, in a nutshell, is fractionalized reserve banking. So they only have to keep 10% of your money, right, in the bank that you deposit, and they're allowed to lend out the rest. If the bank fails, they will cover your money up to $250,000 through the Federal Deposit Insurance Corporation. However, the Federal Deposit Insurance Corporation is funded from tax dollars. So if the bank fails, it's the taxpayers that save the deposits in the bank. And so now, when the government has to print more money, this is where inflation comes in to cover that bank failure. Well, now they have to print more currency, and so that's more of a dilution on our GDP. So that means now, in order to buy products from overseas and bring them into the country, it costs them more dollars. And so now, because of that, the cost of gas goes up, the cost of a TV goes up, the cost of bread goes up. It costs you more US dollars to be able to procure these products. And so because of that, that is known as inflation. And our economy inflates on average 3% a year. So now, I tried to give you guys a nice little overview here and an understanding on fractionalized reserve banking and why it is that banks, hedge funds, 401ks, they're always trying to get you to lock up your money. Put your money in a 401k. You can't take it out without penalties until you're 59 and a half, right? And the reason why that is because as long as that money's sitting there, they can leverage against that money. That's how it works. You buy a 10-year treasury, your money's locked in for 10 years unless you want to pay a penalty to take it out. This is how it works, right? And so as long as that money's locked up, if you get into a hedge fund or, for those of you who are in this chat that are actually invested in the Tulsa Real Estate Fund, he locked up your money for 12 months. Unfortunately, he doesn't understand the concept of leveraging capital. And so therefore, he's not taking advantage of these practices. But, which by the way, did anybody get a dividend from the Tulsa Real Estate Fund? Anybody get a dividend? Any Tulsa Real Estate Fund investors in here? Anybody get a dividend? And dividend day was October 1st, wasn't it? So anyway, neither here nor there. But so that's kind of how fractionalized reserve banking works. I knew this wasn't going to take me very long to get through. So at this point in time, I'd like to open the floor for questions. If anybody has any questions, do feel free to ask. And I will provide answers to those questions. Any questions? Okay, so, if anybody has any question, feel free to, ask, as it relates to fractionalized reserve banking, how it works, anything that wasn't clear in my discussion of fractionalized reserve banking, So how should we be using this info? Well, so you'll understand how the reason why I gave you a background and a great question. The reason I gave you the background of this is, remember, in my last discussion with you guys last week, I talked about current accounts and timed accounts, and I wanted you to understand why timed accounts exist. Why timed accounts exist, why it is that the banks and different 401ks and various different types of investment products want you to leave your money in there for a long period of time. So I needed you to understand that, because when you understand fractionalized reserve banking, you begin to understand the core of how lending works. And we're going to be talking about lending after we cover corporations. I'm going to teach you about the 5 C's of lending, how lending works, what underwriter mentality is, etc., etc. So, it's very important, that I give you this history and give you this foundational concept, so that way you are able to understand and better grasp the lessons that I'm going to be giving you moving forward in finance. It is very, very, very important that you understand this. Should be getting rid of our paper currency. So let's be clear here, right? Let's talk about paper currency. At this day and age, right, everything is done electronically. So when you put your money in a bank account, you get a bank balance. It shows up on your computer or your phone through your app. And based on, it's a ledger. It's just a ledger balance. And based on the numbers on the ledger balance, you can use your debit card up into that amount. Having paper currency in your hand at this point is completely and utterly pointless. It is a waste of time. It is a waste of capital, actually, because you got to think about it like this. If our economy inflates 3% on average every year, that means that if you hold $100 in your hand on January 1st of, let's say, 2021, and then you come back and look at that $100 in January 1st of 2022, it still feels like $100 to you, but the truth of the situation is it only has the purchasing power of $97 because of inflation. So the smart person leaves their money in savvy investments to be able to outpace inflation. The goal is to invest your capital into things that'll make you more than 3% at minimum. That's very, very important, because you got to be able to at least match inflation. If you put your money in a CD and you're not using it as a collateral instrument, you're just using it as a straightforward investment, well, the average CD pays less than 3%. So if you're getting a 2% interest rate on a 10-year CD, you're still losing 1% in inflation. You're still at a net loss of 1%. So all of your investments have to at least make 3% a year. And then remember that anything that you make, and I talked about this, several courses ago, but I talked about taxation and how taxation works, right? So the average person is at 15%. So remember, if you make 3% on your money, you're subject to a capital gains tax. So after you take out the taxes, what really is your net return? So now you have to make even more, because remember, 3% just counts inflation. You got to count the taxes you're going to pay, right? If you're in certain investment vehicles, they have, if you have certain investment vehicles, remember they have management fees associated with them. Some charge 1%, some charge 2%. So you've got to count that as well, right? So all of these things have to be factored into your investment. And this is why I tell people always, if you don't have experience with investing in the securities market, if you don't have general investing experience and general underlying basic foundational fundamental knowledge in the financial markets, it's very important that you put your money in index funds, because over a 10-year period of time, it has been shown that an index fund averages a 10 to 12% per annum average rate of return, or per year average rate of return. So that means you've done better than inflation, you've done better than the taxation. If you reinvest the dividend instead of taking it as cash in your hand and you invest for growth, you're going to get a compounded return. So that's where the rule of 72 comes in, and we're going to talk about the rule of 72 and compounded interest or compounded returns in another course. So that's kind of that. So, investing in index funds is a very, especially if you're doing like S&P 500, if you're doing an index fund based on the Dow Jones Industrial Average, things like that, those are stable companies. Those are companies that have been around a very, 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 very long time. So, you in financial markets, your return is relative to your risk profile, right? So if you're a person that doesn't want to take a whole lot of risk, well, you're going to put that in your projected rate of return. If you're somebody that's very risky and is very into taking risk, your potential rate of return is going to be a lot higher. But again, that's commensurate with the higher level of risk that you're taking, right? So you have to decide what your risk policy is. And what I always advise people and what I always tell people is this: listen, you have to have a core baseline investment policy. And I talked about this several courses ago, but I'll talk about it again. You kind of have to have a core baseline investment policy. Okay, this is the amount of money and the amount of return I want to see on my money every single year. This is what I want. And, then you start designing your investment profile and the types of investments that you invest in to fit that rate of return. And remember, I always tell you, and I'll tell you again, the goal of investing is to maximize capital appreciation while mitigating its risk to its lowest common denominator, which means I want to make as much money as I can while taking the least amount of risk possible. It's great to shoot for the moon when it comes to returns and all of those things, but the first and most important thing is capital preservation. I want to know that there's a greater than not likelihood that in the worst case scenario, the money that I invested, I'm at least going to get that back in the worst case scenario. I want to know that there's a greater than not likelihood of that. And if I'm not comfortable in the fact that in the worst case scenario, I can at least, with a reasonable amount of certainty, at least, because nothing's guaranteed at the end of the day, right? But with a reasonable amount of certainty that in the worst case scenario, I can at least get back what I put into it, that's probably not a good investment for me, to be honest with you. Like that's And, for the average African American, with, savings to income ratios being where they are and, FICO scores being where they are, our community doesn't have a lot of disposable income to just, take a chance on something. And if it doesn't come back, that's okay. That's not okay. Like, for a lot of people, that's going to hurt. Even if it's something as small as $100, that's a big deal, So, I kind of want to put that out there, and so, just, be aware of those things. But we're going to talk about this more because, of course, at a later time, in a later part of this series, we're definitely going to get into, the securities market. We're going to talk about equities. We're going to talk about fixed income and how that works. We're going to talk about cryptocurrency. We're going to take a dive into index funds and, some of the top rated index funds out there. We're going to take a dive into real estate investment trusts, and, we're going to take a dive into real estate in general, right? Where I'm going to teach you how to do real estate in general, how to be a lender in real estate, how to, do these assignment of contracts, how to do these fix and flips, how to buy and hold. Like, I'm going to teach you all of those things. I'll teach you the analytics behind it. It's all numbers at the end of the day. You stick to the numbers, you can't go wrong, right? So let's see. So there's a question from Chef Juan Cooks. How do PE firms fit into this discussion? Private equity firms. So when you're invested, thank you for the question, by the way. When you deal in private equity firms, right? So private equity firms, when you invest your money in them, so first of all, private equity firms are generally only available for accredited investors, as defined under the Security and Exchange Act of 1933 as amended. But generally, when you invest in private equity firms, there's a hold period, right? They want to lock up your money. It's called a lockup period. So they want to lock up your money for 12 months or 24 months before you're able to access that capital again. And so what they generally tend to do, right, as banks do, they want to be able to borrow against your money. They want to be able to lend your money. They want to be able to make investments with your money, and without having to worry about you coming to get it for a period of time. So that's how private equity firms and hedge funds fit into the fractionalized reserve banking discussion. Because, as you can see, fractionalized reserve banking and the concept of fractionalized reserve banking permeates the entire financial industry at this point. And so that's that. Now, the interesting thing is, again, I provided 2 books that you guys should definitely read. One is The Ascent of Money by Niall Ferguson, and the other one is The Creature from Jekyll Island. Nothing I'm telling you hasn't been widely talked about, widely discussed, widely published. This is public knowledge all over the internet. I mean, you can Google fractionalized reserve banking and you can get an understanding of how it works. It's taught in most macroeconomic classes, actually. Most macroeconomics classes cover fractionalized reserve banking and kind of how it works. So that's that. So guys, I'll give a couple more minutes for questions. Let's see. Let me scroll back a little bit here. See what's index funds. So index funds, they're investment vehicles that you put your money in, and the money manager invests in a basket of securities that are tied to either the S&P 500, Dow Jones Industrial Average, or the S&P 100, or a suite of investments that they've chosen for that specific fund, right? Exchange traded funds work a lot very similar. So exchange traded funds are very similar to that. So that's essentially what an index fund is. It's just a vehicle where the money manager is investing in a basket of securities. And what I mean by a basket of securities, different individualized stocks that they've picked that they believe are going to be good performers in the market based on their overall investment policy, which may be the S&P 500. So they're going to pick stocks from the S&P 500 that they believe are going to perform at or over market expectations. So that generally is what an index fund is in a nutshell. So, are there any other questions? What? Any other questions? Okay, awesome, guys. It was a pleasure speaking to everybody today. I appreciate everyone taking the time to listen today. I'm definitely going to save this video so people can watch it at a later time. As always, we hashtag get real woke around here. We hashtag make it make sense. And as always, these lessons that I give you guys are hashtag for the free. So feel free to like, share, subscribe, follow, and tell anybody that you can about the situation that you believe that can benefit from this information. As always, the more eyes we get on the content, the more people will be able to be benefited from the content. I mean, knowledge never hurts, especially when it's being given for free. All right. Thank you guys so much, and I hope you guys have a great day.